And the base rate, we just heard from the Bank of England, has been increased to 3%. So that's a 0.75 percentage point increase. It's the highest rates have been since 2008. We've been saying that all year because we've been in this period of historic low interest rates. The rates came down after the financial crash. They'd not really started to rise before COVID when they dipped to 0.1%. That's the lowest they've ever been. And we're now on this march back up. That's the 8th successive increase in interest rates at the bank's monetary policy committee meetings, which happen every 6 weeks, which is where this decision has been made. We should say that the context of this decision, in the 6 weeks since the last meeting, we've had 2 prime ministers, 2 chancellors, and that loss of credibility in the UK economic situation. I'm not sure if we can show a chart which shows us the path of interest rates. I'm not sure if we have that. Yeah, there it is. And you can see you can see the climb back up. When the steps here, this skyscraper you call this chart, they look a bit more like a Machu Picchu in profile, doesn't it? At the end there of the years, we said we've stepped up in 8 successive meetings. So this gives you an idea of what is happening here. Is the bank in the face of soaring inflation? That's what's driving this. We have inflation above 10%. What the bank is trying to do here is squeeze demand in the economy. One of the tools it has is interest rates. Its aim, remember, is to get inflation down to 2%. So they're looking to squeeze demand to stop us effectively spending more by taking money out of our pockets through by increasing the cost of borrowing, which is obviously particularly affects mortgage holders. And the idea is you will then lower inflation and squeeze inflation. And what they're really worried about here is the inflation, that 10% inflation, is actually driven largely by rising energy costs exacerbated by the war in Ukraine. The thing the bank is worrying about, and I expect we will hear more about and more from our correspondent Ed Conway, who's been in a briefing from the bank all morning. It's very tightly controlled. He's not allowed to leave till midday because it's so market sensitive.
So he'll now be running along corridors.
He is making his way, if I know it, you do it in a vault in the banks, not with the gold, but it is a locked room, no phones, very secure, and he'll be making his way. But what he will have a sense of is what the bank is saying about where interest rates will go and what it expects to happen in terms of GDP, its forecast for the economic health. But what they're looking to do, the worry consistently has been that this imported inflation, if you like, through energy costs, becomes embedded, to use the terminology, through rising wages. We have a labour crisis in this country. We have more vacancies in the economy, forgive me, than there are unemployed people. That is increasing the push from employees for more money because it's harder to employ them, and of course they want their wages to keep up with inflation. The bank's worry is that becomes domestically rooted, so even when the energy price falls, and hopefully that happens, you've got inflation to stay. So that's what the rate rise, in the bluntest terms, is intended to do.
So let's just reiterate for anyone just joining us that the Bank of England has, in the last few moments, raised the base rate of interest by 0.75 percentage points from 2.25% to 3%. That's the biggest single interest rate hike for over 30 years. And it also takes the interest rates, the highest rate since the financial crisis, since 2008, doesn't it, Paul? I mean, the worry, presumably, here is that when we find out a little bit more about the Bank of England's predictions of the direction that growth is going to go into in the country, that we could end up with a situation of still having very high inflation, but also very low growth. And there's this thing called stagflation, isn't there, where you get kind of stuck in this stagnant
Absolutely, and it's an ugly word, and it's a pretty ugly economic state to be in. The bank, remember, last time, certainly the last time the governor spoke at length, was expecting the UK to be in the start of a 5-quarter recession, so expecting to be in recession now, that is, the economy contracting and lasting through all of next year. Now, this is the balance they're trying to work effectively. I mean, the bank does want to slow down the economy. That's what raising rates is about. It's trying to take the heat out of the economy. The balance is not tipping the economy into recession, which starts to hurt people even more. One of the things we want to see is where is the peak going to be? Because there's a hope that in rates and inflation itself cures itself as a brake on them, because the more prices rise, the less we can afford to spend. So it might dampen spending. But this is a balance that this is why central bankers are employed to do this job and why it's such a tricky one. But the intention certainly was to try and cap this. Interesting too to hear what they have to say about and what the market says its assumption is of where interest rates will end. Remember, after the mini budget and the what flowed from that, the huge increase in the cost of government borrowing, the markets were assuming interest rates would be above 6% by next year, and that will have huge consequences for mortgage holders. The fixed rates are already above 6%. They have backed off. That expectation now is that it's perhaps around 5% is where the bank will have to keep raising rates. Will this rate rise do enough to knock that back?